and welcome to Smart Money. I'm Alishia Seckam. This season, of course, brought to you by PPS Investments. And today we're catching up with David Crosoer. He's CIO at PPS. And we're going to be chatting about some of the opportunities and challenges they're having to navigate across the investment landscape right now. So, David, thanks so much for joining us. And I'm going to cut straight to the chase on this one. How investable is South Africa right now? We've got load shedding and broader infrastructure concerns, various socio-economic challenges all plaguing and front of mind for many at the moment.
Yeah, that's a great question. And I think it's very important when you look at investability to work out the price you're paying for something. So South African assets are priced for a lot of the risks that you've mentioned. So when we engage with our managers around the pricing of South African assets, they do look attractive compared to how they've looked at in the past. So investors are getting a lot of compensation for holding on to South African assets. The other point is in difficult environments, companies can often do well. The strong companies can do well if the environments are difficult. So, one often finds that in a difficult environment, strong companies are also able to be quite effective and to defend their market share. More kind of stepping back a little bit, we've clearly been disappointed with the reforms that we've been able to implement in South Africa. It's been sort of, even post the change in political leadership of the governing party almost 5 years ago, we haven't sort of seen the kind of reforms we really would have wanted to see from the government. And clearly we haven't been able to get our economic growth anywhere up to the levels we need to do to all benefit as a country. So, on the one hand, the assets are looking very attractive. On the other hand, we really do need to see the reforms coming through to really see a catalyst to allow investors to really benefit from that. So I think, to answer your question, I think one is getting a lot of compensation here, but what one really needs to see is the meaningful reforms to come through and economic growth to pick up to really benefit from South African assets. So in our own portfolios, we're actually overweight South African cash, given the independence of the Reserve Bank, given the kind of return on offer there. And in the other asset classes, like bonds and equities, where one might thought we would be very overweight given how cheap they're trading, we're actually not at an overweight position there. So despite those attractive evaluations, we are still quite cautious on South African assets, given it's difficult to see when those reforms will come through.
David, you touched on the risk premium associated with emerging markets like South Africa. Fair enough. But investors expect to be rewarded for taking on that additional risk if they do opt to go down that route. So are investors being compensated, and is the ROI making it worth it? Well,
I mean, the returns on offer are kind of incredible. If you think of, say, South African bonds, what they're offering investors in real terms. If one were to have said 5 or 10 years ago, you can get 4 or 5% real returns on South African bonds, most of us would have banked that straight away. So the returns look really attractive. The difficulty is whether we are arresting the slide of growing nominal GDP growth less than the cost of funding our debt, whether we actually see the debt starting to turn. That's the challenge. But it could be very well in 5 or 10 years' time. And when I'm talking to you, hopefully, the question would be, why were you not overweight South African assets? They were looking so attractive. Why were you not holding more of them? So it is interesting how the narrative can change, right? And how investors today think, I don't want any South African assets. It's a basket case. It's not really performing. But typically, when you buy assets at these kind of valuations and you hold them for the long term, they're attractive. And really the critical question is whether we're able to take the medicine we need as a country in order to unlock that potential. And, there's obviously an election coming up this year. It's unlikely to lead to a decisive outcome. And I suppose the challenge is whether we will be able to implement reforms. But on a medium to long-term view, on a 5 to 10 to 15-year view, I don't think it's outlandish to think that we will be able to implement reforms and our economy will be able to pick up growth and we will be able to start performing. And if that is the case, this is a really good entry point for South African assets. Clearly, if we are unable to, if we have another 10 years like we've had up until now, we probably aren't getting enough compensation for South African assets, and it will continue to well, particularly the bonds, will continue to look problematic. So I think investors need to look at both sides of the coin, and when they think around, certainly when we think around how we build portfolios, we try to consider both outcomes. That we don't want to take on a very binary call where we are backing one view regardless of the potential upside from another view, because ultimately we don't know what's going to happen. Ultimately the future will surprise us, and what the market's pricing in is not the thing that's going to catch us out in future. So I think it's important for investors to appreciate that when they build their portfolios and not go for one particular outcome.
Yeah. So with that, the context and how you're positioning yourself within that context, how's it impacting, David, your offshore allocation relative to local?
Yeah. So, I think most of the industry, when the regulations changed a year and a half ago to allow 45% offshore in retirement funds, that's a big change for South African investors. It allows us to hold a lot more offshore than we've held in the past. So in terms of our strategic asset allocation, how we would typically look at asset classes if we felt they were fairly valued, we'd hold as much foreign equities as South African equities in our portfolio. So if everything was priced similarly, we would typically have, say, in a multi-asset high portfolio where most retirement savings are, we would have, say, 35% in South African equities and 35% in global equities if we thought they were priced fairly. And at the time when we implemented that change, I thought we were maybe sticking our neck out a bit, and most investors would still favor South African over global. But in fact, most of the industries moved sort of to that kind of framing where at least half the equities are held offshore. So, we're neutral on South African equities at the moment, even though they look quite inexpensive. And we're also neutral on global equities, even though in the US, maybe they look a little bit more expensive. So we've got a kind of neutral asset allocation with our growth assets in our portfolios, and we're holding meaningful global equity exposure. South Africa is a very small equity market. It's less than 1% of the world. There's a lot of stock-specific risk in South Africa. There's arguably a lot of climate change stranded asset risk too, because we've obviously got a lot of fossil fuel companies given our history. So we tend to like to diversify meaningfully from South Africa. But we're also aware that it's inexpensive, and we still want to hold South African assets. On the fixed interest side, I've been at PPS Investments for over 15 years, and this is the first time we've got a meaningful exposure to global bonds. So we've never really owned global bonds. So we do hold global bonds, and as US interest rates picked up, we started to build a position there. So we do have some global bonds in our portfolios, and we also are overweight global cash. So we're neutral on growth assets, and we overweight more fixed interest assets in the portfolios at the moment. And I suppose there's a lot of potential volatility in the market with the market trying to figure out when the Fed's going to hike. There's a lot of global geopolitical uncertainty. So we're also getting reasonable returns from holding both dollar cash and from holding South African cash. So we're holding a bit more cash than we would typically, but we would use the opportunity of market weakness to allocate that cash into the market if we could. So we got a little bit in reserve in our portfolios, but we would look to deploy that as we expect volatility to continue. We also employ managers who themselves can make asset allocation decisions, and their managers have got different views. And maybe what I found interesting is we've had a lot of our SA-based managers be relatively cautious on South African assets for a long time. But we are starting to see some managers start to think that, there's quite a bit more attractiveness in SA at the moment, and they might actually start to look more closely at South African equities, for example. And that's also an interesting development, given how for so long people have been underweight that. I mean, maybe just to conclude, it is worth reminding ourselves these things go through cycles. So, in the 1990s, it was only foreign equities in the US that really drove things. In the 2000s, we had SA equities doing well for multiple years, right? And post 2008, we've come out of a period of global equities doing well. So investors shouldn't write off an asset class if it's gone through a 10-year period of underperformance. These things do tend to go through cycles.
Absolutely. And what you've touched on there are some of the solutions PPS Investments has in its arsenal, I guess, to help navigate that market volatility, which, like you say, is part and parcel of being in, the investment on the investment scene. I recently spoke to Sean Reuters around the concept of mutuality. And I want you, David, to elaborate a bit more for us on that, how being a mutual impacts your process and the way you solution, because now we're talking more than and broader than just ROI for the individual investor.
Yeah. So I think the most important thing about a mutual is it takes a long-term perspective. So we own by our members, and we're an intergenerational mutual. So we own by the professionals that serve South Africa, and today's professionals and tomorrow's professionals. So by its very nature, a mutual needs to look long-term, and that impacts on how we invest and how we think about investing, because we realize we are playing an infinite game. We are here. PPS has been around for more than 80 years, and we're going to be around hopefully for many more years to come. And our members, we will need to serve our members over a very long time frame. Professionals also tend to live longer than non-professionals. So we know our members. The investment returns we generate for our members needs to outlive our members, and they're often very interested in intergenerational wealth. And so we've got a very long-term perspective in terms of how we think about things. How that applies to how we think about the portfolios is we want to be able to not be taken out by any particular scenario. So, the future is uncertain. So we want to make sure that we build robust portfolios that will do okay, even if we're surprised. And our process tries to ensure that when we build solutions, they can be robust to unexpected outcomes. And as a multi-manager, we have a lot of advantages. It's not surprising that as a mutual, we thought we should be a multi-manager, because we think a multi-manager gives our members the best possible chance of them living out their financial dreams, because we are able to use lots of different managers that we think are unique or have compelling strategies. We're able to find asset classes that a single manager won't be able to build in-house, etc. So, I think one of the outcomes of us being a mutual was thinking multi-management makes a lot of sense for our members, and that's why we're a multi-manager. We also have a lot of insight into our individual members or professionals and what they need and what would work for them. So, an important part of being a mutual is actually solutioning to our professionals and building solutions that are robust to them. I mentioned one aspect was mutual members will live longer through retirement than typical industry. So that's something we've got to think very carefully about in terms of how we build portfolios. More and more females are graduating out of universities in South Africa today than males. So we need to think very carefully around what's applicable for a female cohort of members. And females also live longer than males as well. So I think being a mutual allows us to think very carefully around what our members need, and then work very closely with intermediaries that serve our members around coming with appropriate solutions. And maybe lastly, your conversation with Sean, we very much focused on education. I think education is one way of building resilience for South Africa, and it's a critical component of ensuring South Africa will be a good investment in 10 or 20 years' time. So we very much focused on the cohorts that come out of universities, about helping grow professionals, about how we can support university schools in terms of trying to ensure that we have a big stream of professionals who continue to help grow our economy and our country. And as a mutual, we can take a long-term perspective on that because we can look at the whole educational ecosystem and where we should best intervene to try to help sustain it.
Yeah, and for impact as well. David, thanks so much for having joined us and for your time. It's been a pleasure hosting you on Smart Money today. David Crosoer is CIO at PPS Investments.